Hi there, welcome back. Let's take a look at what we have in store for you today. And for the first segment, then now we're being joined by Amol Joshi, the founder at PlanRupee Investment Services. Amol, thanks so much for taking the time out and joining us on the show today. Let's talk a little bit about debt mutual funds, get our viewers aware about what these mutual funds are and get them up to speed on if this is the right investment instrument for them. So let's kickstart this discussion. And Amol, start off by telling us what exactly a debt mutual fund is. How is it different from an equity mutual fund? So take it away, Amol.
Right. Sneha, this is a good question to begin with. Equity funds, one can say that equity funds are are popular and hence well understood by investors. As everybody knows, as we all know, equity funds invest into equity stocks and shares. Similarly, debt mutual funds invest into debt securities. Though debt securities could be an instrument called as CD, that is certificate of deposit issued by banks, or more commonly, a debt mutual fund or a fixed income mutual fund is a mutual fund that invests into various debt instruments like CDs is one we discussed, and bonds issued by various issuers. Those various issuers could be government issuer, there are government bonds. Then there are PSU, public sector units or public sector undertakings. There are bonds issued by PSUs, and there are bonds issued by private corporate companies, private corporate groups as well. So debt mutual fund very different than equity, and as you rightly said, it can form a part of investors' portfolio and provides very important and crucial asset allocation to investors' portfolios.
All right, well, thanks for those opening remarks coming in, Amol. Now, help us understand who must opt for a debt mutual fund and who would this instrument be a suitable option for? Who is this the right fit for?
Right. See, I would say that debt mutual funds should be used by any and every type of investor. So typically, there are some kind of rules of thumbs where it is said that debt mutual fund is typically useful when you have investment horizon that is spanning few weeks or few months or something that is not really medium term or long term. And over a medium term and long term, you are better off investing into equity fund. Well, as I mentioned, that's a rule of thumb. It is not necessary that it works all the time. Equity investors also can use debt mutual funds. How? Typically, if in your assessment, if a market is at trading at premium valuations, you do not want, and you have investment, a lump sum investment to be made, you would not be wanting to invest the entire corpus at one go. What you would typically do then is invest into a liquid fund. Liquid fund is nothing but one type of a debt or fixed income mutual fund, and from there you do STP, that is systematic transfer plan. That is just one example how even an equity investor would benefit by using debt mutual fund, something like liquid fund. So next question would be, how can one benefit? See, if you want to take a staggered entry into markets, you would probably do a quick 3 month, 6 month kind of SIP from your bank account. However, most bank accounts, saving accounts, will fetch you 2.5%, 3% kind of return. As against that, liquid funds are likely to generate much better returns, something very, very close to 7% or so as things stand now. That is how equity investors can benefit. Other than that, any goal, financial goal that is less than 2 years or 3 years away, you would do well not to go with equity or equity oriented hybrid funds. You would do well to choose debt mutual funds or fixed income mutual funds, whereby chances of drastic movements or chances or capital loss are very, very less. Although I must say here that debt mutual funds also have NAV fluctuations due to various debt market dynamics.
All right, and also take us through the different types of debt funds that are available for investors to invest their money in based on their needs and the time duration that they want to put their money for.
Right. So again, I think I keep going back to equity mutual funds. The way in equity, because simply because equity mutual funds are well known and better understood by investors. The way in equity mutual funds, you have large cap, mid cap, small cap, or flexi cap, multi caps. All I'm trying to say is just the way you have wide range and variety in equity mutual funds. Similarly, same is the case with debt mutual funds. In debt mutual funds, you have a product called overnight fund, and the name itself gives away what it does. Overnight fund, actually, if you have 1 day excess money, in the sense money that you would need only tomorrow, and you want to earn something better than your bank account, savings account, or current account rate, you should actually will go ahead and invest it overnight. This fund is suitable for investments of 1 day, 2 days, 1 week, or 10 days, right? So that is extreme lower end of the spectrum. You have then liquid funds. Liquid funds are suitable typically for few weeks or a fortnight or a month or so. And then you have completely other end of the spectrum where you have a 20, 25, 30 year maturity debt funds as well. Depending on, now the easiest way is you will typically any advisor or planner would suggest you that you should invest in line with your financial goals. Within financial goals, also there are long term and short term goals. Now, let's take an example that you have some kind of lump sum money which you want to kind of allocate for your tuition fee or of your child or children, right? Now, this is the kind of money that you want to earn something better than saving account or something better than short term FD, but you do not want, that 1 lakh rupee becoming anything lower or lesser than that. Hence, you will not be able to go ahead with equities. What do you do? If the tuition fee payment for over next 2 years is 1 year and 2 year away, you will probably go with a low duration fund for your near term requirement and a short term or a medium term fund for your 2 years away kind of a requirement. So there are multiple fund types. There is a dynamic bond fund where fund manager chooses the maturity of the bond to be invested in. So dynamic bond, as the name suggests, is very, very dynamic, is nimble footed. Fund manager has flexibility to invest in a bond maturing in 2 to 3 years or maybe 8 to 10 years as well. Then there are credit risk fund where fund manager essentially has to choose go down the rating curve, choose maybe double A rated or single A rated papers and try to generate alpha compared to other higher rated instruments. So these are multiple types of debt or fixed income mutual funds that you can choose for your investment needs.
All right, and Amol, let me ask you a very important question now. Most people already have their financial plans or their financial goals. They've already begun investing towards it, or they are somewhere along that journey. Now, if you want to incorporate a debt scheme into this, how do you make sure that that scheme that you are picking is perfectly in line with your end goal and mixes very well with the current plan that you already have?
Right, that's a very good question, Snehi. One example we already discussed that you can invest into liquid funds and from liquid funds do the STP. So the purpose here is not to generate yield or returns from your debt investments. The purpose is just to generate slightly more than your saving bank account, and ultimate goal is into investing into equities. So that's just one example. The other example that we have already spoken of is low duration and short term or medium term funds. How debt mutual fund fits perfectly into the plan is there are other ways as well. Now, what are those ways? Is if you have a goal or maturity that is staggered over 2 years, 3 years, 5 years, and 7 years. Typically, you can say that suppose higher education kind of 4 years or 6 years fees payment is something that you have in your mind. And currently, we are in 2024, and your goal is first year of tuition fees payment is due for you for your child is into 2028, 29, 30, so on and so forth. So you also have something called as target maturity funds. Now, again, the name itself is a giveaway. Target maturity fund simply means that it matures at a certain point in time to which you can align your target to. In the sense, if you have fees payment due in 2028, you would choose a fund, a target maturity fund that matures or gives money back to you, comes back to you in year 2028. So that first fund will have a 4 year kind of maturity. For second year tuition fees, you will invest into a 5 year maturity, target maturity kind of a fund, 6 years, 7 years, so on and so forth. This fits very well because you do not have to remember to redeem your investments. Similarly, the fund automatically matures and comes to your bank account. And last but not the least, these are, as we have mentioned, as we are talking about debt or fixed income mutual funds, these are non-equity oriented funds. So you will typically make coupon, the kind of coupon that your fund generates minus the expense ratio of the funds, or call it net YTM. That's the kind of return that you can expect. Obviously, all the target maturity funds here invest into highest rated triple A rated securities. So from that barometer as well, the funds are very, very safe. You will get a coupon for next 4 years. Suppose it is 7%, so you'll get a 7% compounded kind of returns over 4 years, 5 years, so on and so forth. And that's how a debt fund, something like a target maturity fund, fits perfectly into your existing financial plan.
All right, Amol, that's a brilliant answer coming in. Thanks so much for breaking that down for us and helping our viewers understand that aspect. But I also want to ask you, with everything that's been happening globally, we can talk about the Fed keeping its rates steady. The RBI is expected to closely follow the Fed. And in an environment where the market tends to react rather sharply, if I may say, to any interest rate hike, cut, or any anticipation, and if that is not what turns out to be in the market, the stock market reacts in a rather adverse way. Amid a situation like this, would you recommend picking a debt instrument over an equity instrument to anchor yourself somewhere in the market?
Right. Again, I think we are touching upon a very important role that debt mutual fund plays. See, over a long term, equity has proven to be inflation beating asset class. So that is understood by everybody, and people do go to equity to generate kind of higher returns. But there is a part of your portfolio that you want to shield, and that you want to, that you do not want to be exposed to any market volatility. You rightly mentioned debt mutual funds also come and exactly fulfill the very same requirement. These funds do not invest into any equity asset class, any equity shares. So these are primarily shielded from equity markets to begin with, to start with. After having said that, if you choose a highest kind of rating profile to invest into debt mutual funds, then you are also shielded from company defaults. There have been cases that a single A rated or double A rated bonds have either postponed their coupon payments as well as the principal as well as coupon interest payments. In some cases there have been defaults as well. But generally, the AAA rated instruments or quasi government sort of bonds have given an excellent avenue for investors to invest their monies into to any asset class other than equities. Not just that, you also touched upon a point of interest rate cycle. So as we all know, last 1.5, 2, or more than that, globally the central bankers have been hiking interest rates, and that has the way it has reflected in your bank FDs. Bank FDs during COVID, you got as less as 4.75% kind of return, and similar bank FDs are today at north of 7%. Similarly, you also can today invest into highly rated bonds at anywhere close to 7.5% kind of a coupon rate. So that fulfills certainly one aspect where you want to shield your portfolio away from equity market volatility. And not just that, it also does an important function of asset allocation. Just imagine for a moment, when market really falls, you are somebody who thinks that boss, market has fallen by 20, 30, 40%. If only I had money. If you are completely invested into equity markets, you would not be, you wouldn't be having a free cash flow to participate into equity. That is where asset allocation comes into the picture. Your debt market, obviously, not your debt mutual funds. Those are the funds that you can actually kind of switch or redeem and invest into your desired equity portfolio. So these are several kinds of functions that debt mutual fund or fixed income mutual fund fulfill in an investor's portfolio.
All right, Amol, my last question to you is it's a myth buster of sorts. Now, when we talk about a debt mutual fund, we usually use the synonym fixed income. We use both of these terms interchangeably, which also gives an impression in investors' mind that your income over here is to a very large extent guaranteed. While I understand that the risk is nominally or largely lower than when you put your money into an equity mutual fund, it is not always an income that is guaranteed an amount in terms of a fixed amount. Could you elaborate more on this myth that people have in their head that if they put anything into debt mutual funds, their income is going to be a fixed particular amount?
Right, Snehi, very important aspect here, very important point. Fixed income, the kind of the name itself, in this case at least, will it's slightly different than what the reality is. In one of the previous answers, I also touched upon the fact that debt mutual funds NAVs are also kind of subject to debt market volatilities. Now, what kind of volatility? Equity volatility, people understand. Market is up or market is down. That's the kind of volatility that you have in equities. But what happens in debt? Now, in debt, there are various factors. I think we also touched upon a factor of credit risk when I explained the credit risk funds earlier. Those are the issuers who are at the lower rung, single A rated or double A rated or A minus rated. Now, that issuer, the rating A or A minus or double A, tells you that these are not the highest rated, most sound corporates that are out there. But that doesn't mean that they should not be able to mobilize funds via bonds. So that's the reason you have credit risk funds or companies that are lower rated. But there is also one important aspect that we must touch upon is debt mutual fund NAVs are susceptible to volatility based on the interest rate scenario also. Now, this could be slightly complicated to understand, but let's understand it that if the interest rates are going up, then bond prices fall. So it is said that bond prices have inverse relationship with the yield. If the yield or interest rates go up, bond price falls. And although for temporarily, because when the bond ultimately matures, and if the issuer fulfills the obligation of return you the principal and the coupon, you'll make the kind of money that we discussed earlier, yield to maturity sort of the return you'll make. But for the intermediate period, when market rates are rising, the temporary mark to market impact can be there into debt mutual funds. And it not just in some cases, it will reduce your return from, let's say, 7% tentative to something on a lower side, couple of percentage points lower. And there have been cases in the past where interest rates drastically moved overnight. And at least for a temporary period, debt mutual funds generated negative NAV or negative returns for a temporary period as well. Those are certainly the kind of things that one should these are all market linked instruments and subject to market movements, market dynamics. Last but not the least, and that's the very same reason why mutual fund industry, after every kind of advertisement or at every brochure, you will see that past returns are not predictable and mutual fund cannot be projected into the future, as well as mutual funds are not guaranteed instruments. If you remember this and have moderate expectations from this asset class, I think that does a lot of good to your portfolio.
All right, that's excellent, Amol. Thanks so much for joining us and breaking down this entire concept of debt mutual funds for us and our viewers. And viewers, we hope you were able to take a lot of key takeaways from this discussion and this was fruitful for you.
If you like this video, then like, share and subscribe to ET Now.